Welcome to Chart X-Ray. Today we're going to be discussing what the concept of shift in market structure means. You have to first of all look at the higher time frame to see your levels for support and resistance where shift in market structure can occur. There are support and resistance areas where you can look for shift in market structure. But first of all, this is the weekly chart. Looking at the weekly chart, a new week is about to start printing. First of all, we don't know where the shift in market structure might occur. But what we know is if price ever comes to a level of support or resistance, then we can go down to the lower time frames and see if we get a shift in market structure, which will indicate to us that price has responded favorably to that support or resistance idea that we have. So in this case, this is a fair value gap on the weekly chart. It's here in this area. This candle is exposed here because the high of this candle has not touched this candle. So there's a space here, which is referred to as a fair value gap. I'll mark it out for you to see. So that's a fair value gap here on the weekly chart. So ICT teaches this as a support and resistance level. In this case, price is about to open here for a fresh week. So if the week opens and then we see price rally in the first days of the week upwards to the fair value gap here, then we can go down to a lower time frame like the 4-hour chart. The 4-hour chart is very instrumental when you're coming down from the weekly chart, when you're considering shifting market structure off of a weekly chart's support or resistance idea. In other words, a weekly chart's PDRA, an area where you expect price to react off of, like this fair value gap. It is capable of stopping price and sending price downwards. So in the event that we see price early in the week rise up to this level, and if we see a shift in market structure on the 4-hour chart, then we can anticipate that price would find its way down here. This will draw price, this liquidity pool residing here and here. So our bias for that week will be bearish. So we'll go down to the 4-hour chart and see how the week opened and came up to this area, and see if we can find a shift in market structure bearish to indicate that price wants to go lower, because that's what we need to see first before we consider taking shorts. So I'll explain to you what shift in market structure means when we go down to a 4-hour chart. Now this is our resistance level, and we'll go down to 4-hour chart to see how price reacted when it got to this level as the new candle begins to print out here in the new week. So we'll go down to 4-hour chart now. Good. So this is the 4-hour chart, and this is that fair value gap on the weekly chart. Fair value gap that we marked. So notice that once the 4-hour chart came up all the way to this imbalance on the weekly chart, we started seeing a reaction here. But what do we look out for once price hits a high time frame support or resistance level like this? In this case, a fair value gap on the weekly chart. We expect to see a shift in market structure. So we look to the right this way and look for a scenario where we see 3 candles like this, a swing low. 3 candles form a swing low like this. This is candle 1, candle 2, candle 3. I'll label the candles out for you to see. Good. So this is candle 1, candle 2, candle 3. Candle 2 has a wick that is lower than the wick created by candle 1, and candle 3 has a wick that is higher than the one created by candle 2. Candle 2 has the lowest wick or tail. the lowest tail, as you can see. So this creates a swing low. This is what ICT refers to as a swing low. A swing low. So in the event that this candle, if you mark it out in time, in the event that this candle gets broken by price after running into that higher time frame PDRA, which is in this case the weekly chart's fair value gap. So price breaks this swing low after running into the weekly PDRA. Here, this candle breaks it, and it doesn't have to break by closing. The candle can just break by piercing through and closing back above it. It doesn't necessarily have to close below it. Even if it pierces it just by a wick or a tail, it's still okay. It still qualifies as a shift in market structure. So in this case, price shifts market structure by breaking this swing low that exists here. This is the first swing low in price after hitting this weekly fair value gap. So this is what is referred to as a shift in market structure. So as soon as that happens, we take it that price is bearish, and we become interested in this range from this high to this low. We can pull our fibs over this range and then expect price to come to a premium. I will discuss that in the next video, how you can take entries based on this shift in market structure. So once price does this, breaks this swing low like this, anywhere you see a swing low with three candles like this three candle formation, once price breaks the lowest low, that is a shift in market structure, and it tells us that price is now bearish. Price will want to seek lower prices. So for shifting market structure, that's what you need to note first. A swing low being broken after price comes to a high time frame resistance level. In this case, you have a weekly fair value gap. So that's that for shifting market structure. I'll tell you how to use it in the next video.